All right, thanks very much for joining us today. We've been lucky enough to pull Johnny out of quarantine. John is the restructuring and recovery team partner at RSM here in Canberra. Obviously, they're a national accounting firm with a very large presence in a number of different accounting areas. In light of the COVID-19 experiences that we're all going through, and as we can see, everybody's working from home, we thought it'd be prudent to have a chat this week on the podcast in relation to what is bankruptcy, what is insolvency, and get it from the mouth of a professional, because I find when I'm dealing with clients, it's one of those areas that people really sort of listen to their friends, and my mum had this and my cousin's sister's dog walker experienced that. And I thought, in light of some concerns and obviously the impact for people that may have lost their job or maybe servicing mortgages or have assets that are under pressure at the moment, part of the education series that we're going to undertake is obviously closing the loop on some of these things. And we'll be hearing from a mortgage broker next week about how you can restructure assets and things of that nature. But to alleviate any sort of concern, I thought it'd be really prudent to have a chat to Johnny about what he does, how he adds value for people, and when he gets engaged. And then what we're going to do is we're going to touch on some general terminology to sort of alleviate some of the myths and some of the implications of bankruptcy and insolvency and some of these other fandangled terms that Johnny deals with on a day-to-day basis. So, look, without further ado, Johnny, thank you very much.
Hey, Luke, how are you?
Mate, really, really good. Appreciate you taking the time to sort of cover this off. But I think, in light of the current environment and what we're all experiencing and the uncertainty of COVID, if we can sort of debunk some myths in relation to insolvency and bankruptcy and put some clear and sort of concise language around what different terms mean, I think a lot of people out there would appreciate that, because it's one of those things that is a little frightening and it's very unknown, and obviously the implications of it can be quite severe.
Yep.
And I think, to get it from a professional such as yourself is, there's no better way to actually go straight to the top and not listen to all of those examples I gave a little bit earlier. So why don't we start with this? What's your role when you get engaged as a restructuring and recovery team partner at RSM?
I guess practically our role is to act as one of a team of advisors that deal with a particular situation that an individual, be it a mum or a dad, for example, with too much credit card debt or too many personal loans that they can't afford to repay, or a business enterprise through their directors or their management team, bring in to provide specific expert bespoke advice at a particular point in the life cycle of either mum and dad. So, for example, when they're setting out on the journey and they're considering starting up a business and buying a home, we often get retained to provide specific asset protection advice.
Yep.
And then later on in the life cycle, if they hit some speed humps like COVID-19 and all of a sudden mum and or dad have sadly lost their jobs and they're staring down the barrel of $100,000 in credit card debt, big mortgages and property values that are dropping, practically how do they manage through that and what are their options? So on the flip side, we do the same thing with businesses and with parties that I guess are stakeholders in business. So that can look like creditors trying to recover some money, secured or unsecured. It can also look like directors or managers that are either planning for the structuring of their growing enterprise or their new business, but also businesses that again have fallen on tough times. They've maybe accumulated too much ATO liability or too many debts that unfortunately they can't pay off right now because of present circumstances. And effectively, we walk them through their options. But imagine you sit around the table, and usually that table will involve that team of experts, their existing business advisors, so they're registered tax agent, their chartered accountant, or their CPA typically. They might also have their solicitor in the room, giving them guidance around legal issues, and just one of those additional experts that they bring in from time to time to have a confidential conversation will be us.
Yeah, and I think one of the biggest misconceptions that I find when you talk to people that don't know a lot about this space is that you're there to take their stuff. And I think people generally jump to that when in actual fact, it's the exact opposite. You're the professional that's engaged to be able to try and keep things going and keep things running and keep businesses open and make sure that you can actually do a deal with someone like the ADO to work out or work through something like COVID-19 without jumping straight to, I've lost my home, I've lost my business, I've lost my cars, and the whole world's going to come crashing down around me.
Yeah, 100%. And that's a really good point. And the reality is that that typically only happens when all of the other options have been exhausted. So if somebody, for argument's sake, gives me a call, says that their business is struggling, the first thing I don't say to them is, great, you need to appoint a liquidator. The reality is I need to understand what their current position is, what the specific problem is that they're facing, and then let's map out the different options. And the different options can be as simple as getting on the phone and having commercial conversations with key stakeholders like landlords, like the ATO, like the bank, and seeing if you can negotiate repayment arrangements or deferrals of payments or refinancing. All of those simple steps are the early stages. And then right at the end of the line, one of the options certainly, which has pros and cons, is liquidation. And conversely, the other option on the personal side is bankruptcy. But again, it's at the end of the journey. And practically from our perspective, you'll always hear good insolvency experts say that they would always prefer to have a phone conversation as early as possible, because there's no denying the fact that the earlier you make the phone call and you start to plan for a plan B or a plan C scenario, however unlikely it may well be, the more options you'll have available to you and the more flexibility to implement those options. The later you leave it, the less options and the less likelihood of success, certainly in my experience.
Yeah, look, and I think that's one of the things that I've taken from some interactions that we've had where, you know, we'll hypothesize something that's happened or try and alleviate some concern for someone that comes to us with an existing condition. You've always said, get on the front foot, get the cards out on the table and start moving forwards in a way that's actually measured and controlled, so that, as you say, the taking and the losing and all of those sorts of dire things are absolutely plans 9 and 10 when we've kicked off early with 1, 2 and 3.
I think the other thing is the taking and the losing. I think there are a lot of misconceptions, and I think you plan to talk about it later on in the piece. But the reality is, I've been doing this for nearly 20 years, and in that 20-year period, I've never gone into somebody's home in a bankruptcy context and started taking their assets. It's just something practically that doesn't happen day to day. That's absolutely not what happens in a day-to-day run-of-the-mill bankruptcy administration. It's really, really extreme.
Yeah.
And whilst you might hear stories about police officers and sheriffs raiding homes, I think it's probably more in the movies, mate, candidly, than certainly the of what I've seen in Canberra. But in practicality, I'll probably give you 2 examples. It's funny. I always use us, I guess, in many cases as the Plan B scenario strategy. It's often the reality is that we are the Plan B. We're not the preferred solution to a problem. People that refer matters to us or come to us for advice would much rather, they don't typically need to use our services if it's a recovery scenario. But on 2 of the matters that I've worked in, one just recently I got appointed to later last week. The funny thing about that was the director was proactive, or not funny actually, to be fair, really positive thing. Really positive thing was the director was proactive, and for the past 2 years, the director has been working through an active plan to deal with financial struggles that business had been coping with. And the reality is that albeit that director had worked through a plan and a strategy, the strategy just ultimately didn't achieve what he was trying to achieve. So in the end, he had already made Plan B. Not that we'd touched base at all for the last 6 or 9 months, but he knew what his options were. He'd mapped out all the different scenarios, and he knew that at the appropriate time, if he needed to, he knew the pros and cons and what he would do as appoint us as liquidator. So he's done that in that context, fully informed, and we were that sitting on the shelf Plan B if he needed us. And it's funny, kicking around that option and working out what Plan B looks like, you never charge for. So most insolvency practitioners will provide that free Plan B type option scenario up front, just as general guidance at no cost, because it's not specific advice. We map out options, and we want people to feel comfortable enough to give us a call and run those confidential scenarios past us. The other example that always comes to mind for me was a matter last year. So I was appointed with Frank. We traded on an enterprise literally with the view to restructuring its financial affairs and cleaning up its balance sheet. And the objective was to save 300 jobs and maintain continuity of business. And because the advisors that sat us around that table 6 months prior had at least planned for the unlikely event from their perspective at that point in time that they might need to give us a call in 6 months' time thereafter, were aware of the pros and the cons and the options that was available to them. When they gave us a call and they said, right, actually we need to trigger this, we already had mapped out a high-level plan and strategy. They knew the pros and cons. They'd already considered those pros and cons from their perspective. And we worked together to implement a strategy that literally maintained every single customer, resulted in no losses of jobs, resulted in all of the different sites that they operated around the country continuing to operate. And they came out the other side with an approved deal with all of their unsecured creditors, including the tax office, that allowed them to continue to trade and operate, and a tidier balance sheet that now puts them in a position to explore continued expansion across the country. And that, I still remember sitting in that meeting the 6 months prior, being told unequivocally, we're certain we'll never need your assistance, Jono, but I just want to run this past you as effectively a hypothetical. What would it look like? How would it happen? And what are the pros and cons? And that's the perfect type of scenario for me.
That in itself, I think, talks to the value of advice. And I think that is one of the best examples of that misconception that you're there to take stuff. I think the fact that you've always said to me in most scenarios, get on the front foot and let's just throw around an idea. And as you say, that fear that people could have that I want to talk to John, but he's going to cost thousands of dollars. You know, you commented earlier that, you know, there's no fees charged until people are engaged. And obviously there's a huge amount of value as a specialist in this area that you can add to, one, give people a map and say, right, okay, steps 1 through 5. If you need me, I'm here. But 2, I find as well, people are extremely frightened of what they don't understand. Or as I said, you don't know what you don't know. And this has never been more true in the fact that the last thing we want as a client of any business or of any, you know, white collar provider is them sitting at home and stewing and having a negative impact on them mentally, a negative impact on them physically, when jumping on the front foot and having a chat about something, you know, in this sort of context, just to alleviate some of the he said, she said, the misconceptions and the extremes that people jump to, can have a huge amount of value in relation to somebody's perception of a situation and obviously how it's dealt with.
Sorry, mate.
Must be the internet. I was just saying, if you can get in front of this and actually work with people early in the piece, you can keep businesses in place. You can keep people.
I agree.
You don't have to lose assets. And I think, you know, as I was saying earlier, I don't know if we lost the footage, but the unknown scares people and it can hurt you and it can hurt you physically.
I agree.
In actual fact, just understanding, right, here are the steps, here are the implications, and some of the very general topics we're going to sort of touch on in a second can just alleviate that potential of mental health, that you know, physical health, and obviously the health of your business, which you're trying to protect. Because as most self-employed people know, it's your business is like one of your children. You know, it's something that you've worked on and you've loved and you've nurtured, and people are very emotional about that. And keeping it obviously is one of the key priorities that most people have. So let's take a step to the side then and talk about some general terms and some of the differences, because I find they get lumped in the same bucket. Let's break down a few. I've got a couple here on the list. So let's talk about what's the difference between bankruptcy and liquidation.
Okay. So bankruptcy practically in Australia deals with personal liabilities and mums and dads, individuals that have, I guess, incurred too much debt and can't pay it. Then the Bankruptcy Act governs the administration of a bankruptcy administration, which is the recovery of assets for the benefit of creditors and the payment of whatever that pool of funds from realisation is. And we can talk about what those assets look like later on. The term liquidation deals with companies, and it's governed by the Corporations Act. And to be fair, in Australia, it deals with the majority of businesses. So you certainly can have sole trader businesses, and they're governed as individuals under the Bankruptcy Act. But the majority of businesses in Australia are corporate structure or a combination of, for example, corporate trustees of trusts or partnerships of corporate trustees of trusts and that sort of thing. So both of those terms describe specific administrations under those legislations. So, for example, under the Bankruptcy Act, there are different types of administrations you can enter into before bankruptcy to avoid bankruptcy. So when you say to an insolvency expert, I'd like to go bankrupt, that's just one of a number of options you have, and it's a specific type of administration. And the word means you want to effectively sell what's available that can be sold, the visible property, contribute some income, and then contribute that to your creditors, set and forget, I go bankrupt for a period of time. It doesn't mean that you're looking to avoid bankruptcy and explore the other options. Conversely, liquidation means, practically to insolvency expert, my business, if it's an insolvent liquidation, because there's another bit of complexity, you can have a solvent liquidation. So at the end of a company's life cycle, you can actually wind it up when it's completely solvent and it's just at the end of its useful life. And we do a lot of that work as part of the restructuring side of things. But the insolvent liquidation side of that term or that coin means that the business isn't viable, it can't be saved, and if you want to enter into it voluntarily, you would appoint a liquidator to effectively recover the assets, sell the assets, and distribute them to the creditors.
In a similar analogy, it's a bit like Botox.
Yep.
It's a brand, not the procedure.
Yep.
Not that either of us have, gone down that road.
Maybe we need to.
Well, I find that analogy works in that sort of scenario, because a lot of people think that Botox is the procedure, which actually is a brand, which is one of many that performs a medical function. So they're those two. Let's now talk about voluntary administration and receivership.
Okay, so voluntary administration and receivership only deal with appointments under the Corporations Act. So you're dealing with companies again, or corporate trustees of trusts effectively. Effectively, you're dealing with the majority of businesses again. So if I hear the term voluntary administration, I know I'm dealing with a company effectively. What I also hear from that is that more than likely the directors have made the appointment. There are other ways that you can be appointed, but the most common one is the directors make the appointment. And the directors are usually wanting to appoint a voluntary administrator to effect a strategy to save the business. So if I hear voluntary administrator appointed, I'm hearing that the directors are exploring all options to try and save the business. It may be terminal, but it's not necessarily terminal, and they're trying to effect a restructure. So I talked before about the example where we saved the 300 jobs. That was done through a voluntary administration and a restructure, whereas the one where the director had talked to us 2 years prior, that was a liquidation because it was terminal, insolvent, and being put to bed.
So again, of getting on the front foot and being able to say, look, let's engage a professional, help us through this. We'd love it to stay alive. It's our baby for someone. And we want to come out the other side of it. That's where you add your skill set to keep things trading.
Oh, 100%. And if we look at the voluntary administration side of things, the reason why that voluntary administration, and not the only reasons, but key reasons why it was successful, was it had access to working capital. It still had the support of its clients and its customers. It still had the support of its employees and its key stakeholders. So it wasn't so sick that it exhausted all of its resources, all of its goodwill with its clients, all of its goodwill with its suppliers, all its goodwill with its employees, that we couldn't rely on that support, that goodwill to work through the process. Because the reality is that with every process is a little bit of pain. It's just the nature of it. The reality is there needs to be some give and take, and you need to go back to that well of goodwill and have a business that fundamentally is viable but is a bit sick, not a business that's terminal. Now, coming back to the receivership language, so the most common form of receivership that we see deals with companies again, predominantly, and it deals with predominantly secured creditors enforcing their security to take control of assets or take control of an enterprise to pay off their debt. So the term receivership can be quite complex and more broad. You can have court-appointed receivers to do other things, but the most common one, when you hear the term receivership, it typically means that a secured creditor, so a bank, a lender, a financier who holds appropriate security, has exercised its rights to appoint a receiver to act for the bank to take control of those assets or that business to pay out the debt that's owed to the bank primarily.
Right. So in a good example, you haven't made a mortgage payment for 2 years, the bank wants their money back, they're going to take your home, extinguish the debt, and provide proceeds to you as the receiver of whatever's left.
As an example, but practically the way that it would really happen in a company, it's usually a company context that we would operate in, is that the bank would exercise its right to appoint a receiver, and the receiver goes in as effectively the operator or the expert acting for the bank, and the receiver goes in, takes control, trades on the business if it needs to, or sells the assets if it needs to, to just primarily pay out the bank to the debt. Then they have duties and obligations. They can't just fire sale things, and I know there's a misconception around that. But if I hear the word receivership, I typically mean that a bank wants to exit, or typically hear that a bank wants to exit, and then it also might be accompanied by a voluntary administration or a liquidation. But critically, the receiver is usually in control of the affairs. It means the bank's exercising those rights typically.
Okay. So in other words, in that example there, people have left it too late?
Yep, usually.
And that's
usually. And look, that's a really good observation, because particularly in the current environment, particularly in the post-Royal Commission environment, the banks do not want to appoint receivers and enforce their security. It's not even a last resort. It's an option that just is so rarely on the table these days that it needs to absolutely be that it is the only option. Because prior to that, I've seen cases where the banks will work for years and years and years to try and find an amicable resolution with their clients. I know there's plenty of commentary around cases where allegedly the banks have acted inappropriately, but in my experience, I've seen that most, if not all, major lenders very much so open to wanting to work with their distressed clients. I know certainly at the moment, since COVID-19's obviously hit small business, every single bank has very clear policies around the type of support that they will give to small business customers, and guaranteed at the front of their mind is not appointing receivers.
And that's it. Something that is viable can live to fight another day, and don't then have the broader financial implications of devaluing assets, especially from a lending standpoint. Bank then starts a potential GFC-like credit environment that can really get into them, and that's not what anybody needs in the current environment. So,
no, I agree.
Again, another good example of get on the front foot, have a chat, have a plan. It's not a bad thing. You're not going to be the first one going through it. You won't be the last. And you'd hate to find out later down the road that you could have done things and been proactive that could have avoided certain outcomes in certain situations.
Oh, there'll be something you didn't know if you don't surround yourself with experts, as you always point out, Luke. There will absolutely be something that there's no way you could have known. I mean, I'm a chartered accountant and I don't do my personal tax return because it's not my expertise.
Yeah, exactly. All right, so that's some, I guess, clarifies some language. Let's now bring it down to a more personal level, and I've got 4 or 5 sort of key things that I get asked, depending on obviously what happens and can things happen in this way or that way. So let's pose some questions that I get, and then you can come into it as the liquidator or the restructuring and recovery team partner.
Yep.
It sounds far less scary, doesn't it? So I've lost my job. I've got too much debt. What are my options?
So first and foremost, what I would say is inform yourself of those options. And the way to do that practically is, if you have an existing trusted advisor, that can often be someone like you, Luke, to be fair, as a financial advisor, or conversely, it's often the registered tax agent, so often the accountant that they turn to for personal advice, at least annually, give them a call. So give them a call, ask the question, talk them through your current circumstances, because what I find is a lot of people, particularly mums and dads that get tax returns done, I guess, practically, and don't necessarily get business advice, they don't appreciate that their accountants are skilled and equipped to do so much, or their business advisors, skilled and equipped to do so much more than just do their tax returns or their taxation lodgements. So from there, what that expert typically will do, in my experience, is map out those different options. And those options can look like going and engaging with a financial counsellor. That's probably the most common one that I see people at least explore in first instance. Financial counsellors often will provide their services to the community at no charge. So organisations like the Salvation Army, for example, provide trained financial counsellors to work through your current position, assist you to map out a true and genuine budget, and also will assist you then with the options to try and deal with your debt problems. And some of those options then, from the financial counsellor's perspective, will often look like negotiating with credit card customers or credit card companies to see if you can settle credit cards for less than the full face value, or defer credit card payments, negotiate with banks to see if you can defer loans or seek hardship support. Also also perhaps assist you with refinancing applications. So they're usually the first points of call. Then from there, outside of that, I guess it's probably going back to the trusted advisor to explore options outside of these. What are my other options? Typically, those other options then look like something that an expert like our office would assist with. And coming back to that Bankruptcy Act conversation before, the Bankruptcy Act provides 3 different types of administrations to deal with unmanageable debts. And those 3 different types are called a Part 9 arrangement, so literally Part 9 because it's governed by Part 9 of the Bankruptcy Act, a Part 10 arrangement, again governed by Part 10 of the Bankruptcy Act, and then bankruptcy itself. And literally in that order, that usually is the natural flow of things. So informally try and negotiate the problem. Outside of that, look at a Part 9, look at a Part 10, and then contemplate worst case last position bankruptcy. A Part 9 and a Part 10 effectively look like putting a proposal to your creditors to compromise your debts. Usually you pay money over time. Usually the scenario looks like keeping certain assets like your house, but paying an amount of money, cents on the dollar, to retain those assets and avoid bankruptcy. It's often paid from income, and particularly in a Part 9 world, there are certain criteria around the level of your income, the value of the assets that you own, and the value of your debt. If you don't fit that criteria, you pop into Part 10 because it's everything else in that context. And then if none of that works, then you're looking at bankruptcy.
Right. Again, so it always depends on your situation. And again, something that people should take from that is what's happened to someone else doesn't necessarily mean it will happen to you. It's definitely a case-by-case basis, looking at assets, time, liabilities, and all the other factors that you've touched on there to try and get the best possible outcome.
Yep, and I would say that the majority of financial distress for mums and dads and individuals in Australia are dealt with around that first tier of engaging informally with your trusted advisor to look at your options and negotiate with your creditors, and then with the assistance of financial counsellors.
Right. Okay. So what are the, again, if somebody does go bankrupt, you can't be a director of a company, you can't do certain things, you can't have borrowings, all of those sorts of things. What are some of the implications of becoming bankrupt?
Yep. So practically there is obviously a long list of different things that can happen in the event that you're bankrupt, and duties and obligations. But the most practical ones that I certainly always get asked about is what's going to happen to the family home. But the reality is that divisible property, so that's the term that we use under the Bankruptcy Act, is available if it's your property to satisfy your debts. So there are exclusions to that divisible property. And exclusions include, for example, personal effects. So that's when I come back to not going into people's homes, practically your clothes, your furniture, all of those personal effects and items, they're exempt property. Superannuation in a regulated superannuation fund, as long as you haven't transferred funds there effectively to avoid your creditors, that's exempt. Certain assets, including tools of trades, up to a certain value, a motor vehicle with net equity up to a certain value, i.e. about $8,000, that's all exempt. So then practically what is typically most at risk is your interest in the matrimonial home or any other investments. So what is at risk is any shares that are tradable or realisable, so ASX shares, any other investments generally, collectibles, so pens, Luke. Long pens would more than likely be at risk. Well, they would be at risk, especially if they're yours and you've got as many as you. And practically outside of that, the matrimonial home. But the critical consideration there is it's only your interest in those assets. And the reason why I say that is most individuals in Australia typically, simplistically, will own their home as joint tenants, in my experience. So typically the starting proposition is it's 50-50. It's quite a complex area, and the reality is that it doesn't always end up as 50-50. It can certainly be a different calculation, and accountants and lawyers will argue about that till the cows come home. But practically the starting proposition is typically 50% of the equity in the home that is your interest. If you're the bankrupt, that's what's at risk. So for example, with my wife and I, what's at risk really typically is my assets if I went bankrupt. So anything in my name, the things I talked about before, as well as my interest in our joint assets. It's not everything that we own jointly, and it's nothing that Tiana my wife owns herself.
Okay.
So I guess that's usually the most painful side of things, or the concern. The other reality is that for the 3 years that you're bankrupt, you need to pay a certain portion of your income, if it exceeds a certain threshold, towards your bankruptcy estate. But assuming you don't have any children, your income needs to exceed about $75,000 a year for you to pay any contributions. And those contributions only end up a very small portion of your income. So they're usually practically the queries that we get. The other one in Canberra is certainly around security clearances with Australian Public Service. The reality is I can't give any guarantees. So there's no guarantees that it wouldn't affect your security clearance. But the reality is, we do have a number of current bankrupts and have historically had a number of bankrupts that have security clearances. And they've always successfully, in my experience, renewed their clearances and retained their clearances. And I believe that the argument in that context is you're actually a lesser risk than if you have significant debt and you're not bankrupt, because if you are bankrupt, you're discharged from your debts. So then you're a lower risk in terms of a foreign individual or some third party perhaps coercing you financially to do certain things if you did have significant debt.
Turn a positive or a negative into a positive, as they say.
That's exactly right.
Well, look, I think they're the ones that I see, especially in relation to what could happen. Am I going to be living in a tent? Have I lost my car? Can I not get to work? As you've said there, again, case by case, what do you own? What is your equitable interest in something? And obviously that the assessment that obviously you need to live and be able to exist and do things with certain thresholds. So I think that's great because it gives people that comfort. It should give people the comfort to know that everything's not going to walk out the door. Your life doesn't stop as you know it. And you do have a means to be able to continue to work and trade and do whatever you choose to do as your vocation or occupation, and be able to continue things as they are with that in mind, taking into account the certain rules and regs in relation to the thresholds of income, assets, and what you own as an individual. Because I think one of the big things you hit on there is you've become bankrupt, not we've become bankrupt.
Yeah, that's exactly right.
Couple. And I think that's one that I get a lot in relation to queries with that sort of stuff, because people think that collectively we have a home and we have cars and we have money in the bank. And that point of fear is, well, I could lose something here, but I didn't do it, because there's always two sides to that conversation. And that'd be one of the challenges you have of, as you said earlier, that's one of the painful processes of working through that part of it to get to, well, what's actually on the table and what can we actually take off the table and you can continue to have and use.
Well, I think practically, Luke, honestly, what we tend to do whenever we get a phone call from somebody, literally it will be a phone call saying, look, I'm looking at exploring going bankrupt. Can you talk me through what that would look like? We'll literally over the phone just ask for a confidential snapshot of their current income position, their assets, their liabilities. We'll then talk to them about whether or not they have a significant other, and we'll assess the same position for their joint assets, liabilities and income, and also their significant other's position. And then we'll actually bespoke talk them through the implications for what their administration would entail. And I'll give you a classic example. I'm currently assisting a young couple who are just in their early 30s to explore going bankrupt. They've practically looked at the debt that they've incurred, and collectively they've got over $100,000 in credit card debt. They are managing to repay that at the moment, but barely. They've got a young family. They don't own a home. They're trying to save for a house. They don't own a home. They're not directors in a business. They don't have collectibles. They don't have investments. Effectively, what they have is their income, their household effects, and some superannuation. And practically what they've realised is that at the moment they're paying about $4,000 a month towards minimum repayments, largely on personal loans and credit cards. So the income contributions that they would collectively pay at their income levels under bankruptcy would practically save them about $30,000 a year. And what they're looking to do is save that $30,000 a year practically and build up a bit of a nest egg, so that at the end of their 3 years of bankruptcy, they'll have money to go towards a deposit for a home. So practically they've looked at their circumstances and said, you know what, all that big long list of potential implications, like you can't be a director or manager of a corporation, an interest in a unit trust might vest in the trustee, all those things are irrelevant to them.
Mm.
They've sat there and said, you know what, in real commercial terms, I'm going to save money, and I just want to draw a line in the sand and a fresh start. And often, to be candid, bankruptcy is a fresh start. It's actually designed to not be a penal sentence. Bankruptcy jail went out a long, long time ago, and now it is designed to be a confidential fresh start that sees more than 15,000 Australians a year go bankrupt, and you could walk down the street, walk past one, and you wouldn't know that.
Yeah. Well, I'll take that one off my list then. Am I going to jail? I'll cross that one off the list. No.
You'd have to be really, really bad.
And that's only after they've taken all my pens. So I'll make a note of that.
That would probably have to involve one of those really rare occasions that no one ever sees, where the police are raiding properties. And again,
you might have to go and
really have to do
all right. Well, I think that dispels a huge number of preconceived assumptions that people come in with, because I know it's, like as we said earlier on in the show, it's one of those things that has a lot of grey around it. And there's not a lot of people out there that have that specialisation like you to be able to sort of work your way through the different scenarios and actually give people, okay, you're going to become bankrupt, and here's the positive. I'm going to save you $30,000 to $40,000 a year. And I think if you tried to say that to somebody and say, look, go bankrupt, you'll save 30 grand a year, they sort of look at you, scratch their head and go, how many coronas have you had? You know, it's not something you expect someone to say, which is again, a testament to, we're here to restructure, we're here to recover, we're here to help you, get advice, have a chat, and don't kill yourself trying to think you're doing the right thing, because you don't know the actual implications of the decisions that you could make to come out the other side stronger and better off at the end of that 3-year period.
And critically, it's about weighing up the bespoke pros and cons for you. So if you sit there and, for argument's sake, you're not a director of a business or managing a corporation, you don't intend to for the next 3 years, then that's not a concern for you. Mm. The reality is it's not pain-free, though. No possible resolution to debt is ever pain-free. So there are negatives. For example, I regularly get asked questions about credit ratings and national databases and that sort of thing. And practically, the reality is, yes, there will be a public record for life that you've been a bankrupt, and certainly it will affect your credit rating, and that credit information is maintained by those different agencies for a period of time. But my practical response to that is, if you're in default of your arrangements with your creditors and they're chasing you, you've already got those concerns practically around the impact, or at least part of the impact of your credit history, and you're probably avoiding the inevitable. So that's just crystallising something that really came about as a consequence of all of the debt that you have, or the circumstances that you find yourself in. And what I do regularly see is, yes, people that have been bankrupt do get home loans. They do get credit in the future, but it might not be with a big four bank. It might mean that they need a guarantee from mum or dad or a significant other, or it might well be that they have to pay a higher margin of interest because that financier sees them as a higher risk until they rebuild a credit history. But do I see big four banks lend to former bankrupts? Yes.
Yeah.
I'm a mortgage broker that we do a fair bit of work with, Luke. Practically yourself and myself, I've seen instances where bankrupts that have exited bankruptcy, I've referred them through to that mortgage broker, and that mortgage broker has successfully gotten loans on particular circumstances for former bankrupts. So it's not that you will not get a loan, but there's no denying the fact that you'll need to work through that process and some of those pros and cons.
Yeah, and again, I think it's one of those things that people can't make the assumption that because something's happened to someone they know means that their situation will go down the same road. It very much is a bespoke environment of your situation, your financial position, your cash flow, your assets, your liabilities, and all of the things that get weighed up in that bucket. Again, the worst thing I think anybody could make as an assumption here is, well, this happened to Johnny, or this happened to Dave, or this happened to Reese, and it's going to happen to me. The value of finding that right off the bat, what are my options and how can I play it best?
Yeah, but critically also, Luke, what I find is once we get a snapshot of what your position is, asking the question, what do you want to achieve? Because I'm often blown away by the client's fundamental motivations. And by that, I mean that it's not everybody's primary motivation, and I understand why. They just want to save money. I've had a number of people that talk to me about their options and say, you know what, I'm glad I understand what the pros and cons of bankruptcy are. My principles dictate that there's no way I'm not paying my debts, and I'll work till I'm 100 and however many years old to keep going. So I'm going to do that. I'm fully informed, but thank you very much. I'm going to move forward.
Yeah.
Conversely, some people say to me, I just want the phone to stop. I want the debt collectors to stop ringing me. I don't want to feel stressed anymore. My mental health and my relationship with my family are fundamental, and all of those are a significant concern for me. How do we deal with that? And it's funny that by enacting the Bankruptcy Act, the phone stops ringing. They have to ring the trustee. And it's often simply, that's the biggest weight off people's shoulders. They sit there and they go, wow, I wish I'd done this before, because that was my primary concern. I was worried about something that really wouldn't affect me practically the way I thought it would. Sure, it's not ideal that now I can't go and use my credit card because I've just chopped it up. But conversely, I don't have to pay that $20,000 right now that I can't afford. And that debt collector that's rung me every single day for however long is ringing.
Yeah. And I think that ties back into what we said earlier about people's mental health and their well-being. I think this can have some very severe or adverse effects personally or in a relationship, as you touched on earlier, and getting out in front of it and taking away some of those things that causes the angst and the fear and the frustration can actually then help you move forward in positive steps. And as you say, nothing's without pain. But again, if you don't work through it, you're not going to be able to get around the things that are causing you the greatest amount of angst and concern and get an outcome sooner rather than later. Because I've never met anybody that says, oh, wow, I started saving earlier than I thought and now I've got all this money in retirement. What am I going to do with it? I've never had anybody complain about that. I've had a lot of people come in too late and say, well, what do I do now? And have to force the issue in relation to the decisions that they can make. And I think this is another good example of the way that being informed, being progressive, and getting in front of this early can actually have some really positive outcomes through an otherwise fairly difficult or traumatic event for most people.
Yeah, agree entirely.
Okay, so that's the personal side of things. And now I think we're just going to touch on a couple of sort of business-related issues that I think are quite topical at the moment for those that are self-employed. And I've got a couple of questions here that sort of get thrown around on phone calls and in the pub, and we can get to them. The first one first cab off the rank is obviously my business has been affected by COVID-19. What should I or could I consider doing to try and protect my position?
And that's the number one question I'm getting at the moment as well, to be candid. So first and foremost, don't wait 6 months. You've got a very, very small window to get the right advice, prepare a plan, be fully informed, and candidly get ready for the tsunami that's coming. I know certainly the analogy that I'm seeing from a medical perspective, but also from a financial perspective that's being used, is it's like the tsunami prior to hitting or making landfall, where the water is currently going out to sea and the tsunami wall is forming and it's coming. But the really good thing that the federal government has done, and it's been effective, it's definitely given small business owners that are distressed some breathing space, certainly more than what they would have had, is they've given them a window of time. And the way they've given them that limited window of time is effectively by reducing the amount of court activity that the ATO is undertaking. So the ATO has very much reduced its enforcement debt recovery activity. We've seen that. And by that, I mean the number of bankruptcy applications, liquidation applications through the courts, but other proceedings that we're seeing. So that's good for small business owners. The other way that practically we're seeing there's been benefit for that creation of that 6-month window is a relaxing of the insolvent trading risk to business owners. So you're probably certainly aware, Luke, but as a director of a company, you have a positive duty to ensure that if you're incurring a debt on a day-to-day basis, reasonably you need to be able to repay. Obviously, in the uncertain environment of COVID-19, I think most directors of companies are understandably very concerned about continuing to trade. The federal government has made certain legislative changes to the Corporations Act to provide some breathing space where a director effectively is released from that obligation as long as the debts are incurred in the ordinary course of continuing to trade the business, and they can justify effectively that the debts they're incurring are reasonable and that their conduct is reasonable. I would caution people with that because I think practically there's a bit of a misnomer around, from my perspective, a bit of a misnomer around whether or not that gives directors carte blanche protection. I think very clearly it doesn't. The reality is, as a director of a company, you have statutory duties generally under 180, 181, for example, the Corporations Act or sections. as well as fiduciary duties. And those duties include just simply acting with due care and diligence. So those duties right now remain alive. And the question is, as a director of a company who knows that they're trading in an environment that has COVID-19 and all of the different economic impacts that are impacting their businesses, is it reasonable for that director of that business not to pick up the phone, talk to their trusted advisor and prepare a plan? I think the answer would be no, and that conduct would definitely be reviewed, in my mind, in the event that that business failed. So I think that's a tip for small business owners. They've got a limited window, and they are still at risk. They very much need to be proactive and develop that plan during this window. And that first point of call for me is ringing that trusted advisor again. So ring your business advisor, ring your chartered accountant, your CPA, your IPA, registered tax agent. Sit down, prepare a plan, and that plan really should incorporate plan A, plan B, plan C.
I think that's
maybe on plan C,
because there have been a number of initiatives from the government to try and get people through this, and I think there's always going to be a fallout of that, or a little side strategy that could be perceived as, oh, here's an opportunity to do something, which isn't in the spirit of why something was created. And I know in my world, we've had the $10,000 access to superannuation discussion,
yep.
And people then trying to take advantage of that to pull money out, to make a deductible contribution, to put the money back in. Now, that was just a sort of it was collateral damage in relation to the purpose of trying to get people through one of the most difficult times they've probably ever been through, not to try and manipulate the system and make deductible contributions for your benefit. So as we've said to most people, could you do it? Yes, you could. But why would you then go and wave a big red flag in front of a regulator that isn't in the spirit of why it was created in the first place? And I think that's really, really important, that point you've made there about, can you do it? Are you being fair and reasonable? And are you acting in the best interest under the duties that you have? So that at the end of this, if your behaviour was ever called into question, you could stand there with your hand on your heart and say, I've acted within all of my fiduciary duties as a director to maintain an entity through one of the most difficult times that we'll probably look back on and take some very good things from, but also have some fairly deep scars for some people that will take some time to get over.
I agree entirely. And the question is, to be fair, if in this current environment, those risks exist, they're not potential risks, they're real risks to your business. You don't surround yourself with those experts, and you're making ill-informed or poorly informed decisions. The question is, was that appropriate? Should you have rung your legal advisor? Should you have rung your financial advisor? Is it reasonable the director in those circumstances would have done those things? And that would be my key suggestion. Spend the time and the energy becoming fully informed so that you can prepare an appropriate plan. That's critical.
Yeah, look, I think that for me is probably, how the radio show started on 2CC as part of our education program, because I got so tired or so frustrated of people coming in at any age, sitting down and talking through strategies, and then finding out that they could have done it 3, 4, 5, 6 years earlier, but didn't have the catalyst to come in and have the chat because they hadn't been made redundant. The government hadn't given them some money to find out about something, or they hadn't had a family member get some advice that they then saw the benefit of. So I think you have to be able to reach out and find out the things that are most important to you and the things that are going to have a direct impact on you as an individual, you as the director, and obviously the business or the organisation that you're responsible for, so that you adhere to all of those duties going forwards. Because there's nothing more frustrating, and you'd see it a lot as well, where you'd look at someone's situation and say, had you said this to me at this time, I could have avoided this. And I think sometimes people's pride can also get in the way of it. And I think this is one of those times where I think we've touched on a number of examples today where talk to someone.
Because I agree entirely. Certainly, look, sorry, mate. Certainly, the reality is that when you're a small business owner and you're a director of a company, you do have the weight of the world on your shoulders, in the sense that whilst the company obviously incurs the debt, so typically your business advisor will have structured your business in an incorporated entity for a couple of primary reasons. One would be tax minimisation appropriately, But also the other one would be adopting the separate legal entity principle and asset protection from you personally. So the company incurs the debts, it's a separate entity to you as a director and an individual. The reality is most small businesses are family enterprises, they're commingled with personal affairs, you'll have personal guarantees, and you run the risk that even though you think you might be doing the right thing, you don't inform yourself appropriately and you make a mistake. So potentially you breach your director's duties. You sign those personal guarantees. So if you don't make the right decisions, and for argument's sake, you go and you create a war chest by refinancing your house, or for argument's sake, you access superannuation early and then you spend all the money, you don't get the advice on how best to spend all the money, and there's still debt left over and you've still got problems left over, then there's no more war chest left. So then you've created a bigger personal liability problem for yourself. The other one is that the ATO, although I expect that activity to reduce significantly during COVID-19, the ATO can issue you with director's penalty notice. So if the ATO issues you with a director's penalty notice, it can render you personally liable for GST, POIG and SGC if you don't act appropriately or haven't lodged on time. So when all those things happen, whilst you've been set up in this corporate vehicle to give you some protection, that corporate vehicle can be pierced or attacked, and ultimately the attack ends up on your lap as an individual and becomes your risk. So whichever way you slice and dice the pie, a small business owner is exposed. It's their livelihood. So if it was my exposure, I'd want to make sure I was fully informed about all the decisions I was making to mitigate all that risk.
Mate, unreal. Look, I think that's more than most people can probably consume in the best part of 45 to 50 minutes. Look, if there are people out there that are unsure or, want to reach out and get in touch with you, mate, how can they go about doing it?
They can give me a call. So my number is 621-70341. That's my direct line. So I'm more than happy to have a confidential conversation with anybody. Conversely, they can email me. All my mates call me John, but the reality is my name's Jonathon. So my email address, Jonathon, Jonathon, .Colbran, COLBRAN, @rsm.com.au. The other thing is just go to our website. So a bit of a plug for the firm. Honestly, our COVID-19 resource is nationally recognised. I know the Institute of Chartered Accountants in Australia and New Zealand are actually referring members to our firm for our free available resources. We've got fantastic summaries of the sorts of support that people can expect to receive from the different financiers, different summaries of all of the different state and federal and territory stimulus measures. They're updated daily. It's an excellent resource, but there's certainly a lot of value in getting an expert to explain all of that to you.
Mate, listen, we can't thank you enough for coming on the show and for taking your time out. Obviously, we've had kids in and kids out and babies getting dropped off and all sorts of other working at home.
We're living in the real world, mate.
I appreciate your time as always, mate. And if anybody needs to reach out, they can. And I think the one thing I've taken from today is get in front of it, get some help, and don't let the assumptions that you don't understand eat you up from the inside when you can get a positive outcome faster than you realise.
Thank you very much for the opportunity.
My pleasure. Talk to you soon, buddy.
Cheers, mate.
See you, mate. Bye.